In this short video, what I want to do is I want to talk through what are your options when it comes to your interest rate and when it comes to your closing costs. Because these are some of the bigger items, the bigger things that everybody who buys a house is. When I buy a house, what does that look like? What are my options and how does it work? And how can I use it to my advantage? So first of all, let me explain interest rates with you. As a lender or as a loan officer, what we look at when we're looking at interest rates, we have this stack of interest rates that's on a one-page document essentially. And it shows us a whole list of rates. It might go from as low as 4% and all the way up to 8%. It's done in eighths of a percent. So an eighth of a percent is the difference between 5% and 5.125. That's an eighth of a percent in rate. And we see that all the way up. So it'll be 4.125, 4.25, 4.375, 4.5, and so forth, all the way up. Well, there is a dollar amount associated with every interest rate. A lot of people have heard the word buying points. It's just a term that's used to buy the percentage down in interest rate. What it means very practically is it's just a dollar amount associated with each interest rate. So when we look at that rate sheet, what happens is in the very middle of that rate sheet, there's an interest rate that essentially costs you $0. We call that the par rate. That's just a lending term. That's the par interest rate. It's going to cost you $0. If this is your teeter-totter, you have the interest rate over here and you have the price of the interest rate over here. Let's just say this is 6% on this side and this over here is $0 for that rate. As the interest rate goes higher, inversely, as the interest rate goes lower, the cost for that rate goes up. So here's what that means. They may want to take a higher interest rate than the par rate because it comes what's called a lender credit. What's a lender credit used for? A lender credit is used to actually lower your closing costs. So you can benefit that way where you take a little bit of a higher interest rate, which has a little bit of a higher monthly mortgage payment, but you're keeping a little bit more extra money in your pocket. If you decide to buy the rate down, what that means is you're buying points, you're buying a percentage down, that dollar amount goes up. So you have that par interest rate, right? That costs you $0, but to buy the rate down, the price goes up. Well, the math that we help people understand with that is what's the difference in my payment? The par rate, let's just say my monthly payment is going to be $3,500. If my payment at the par rate is $3,500, but I could spend $1,500 to buy the rate down an eighth of a rate, the difference in payment on that is $30 a month. Well, that's awesome. How long is it going to take for me to make up the $1,500 that I spent on that rate? So we just do a calculation. So $30 of savings every month times 12 months is going to be $360 for the year. Well, how many years is it going to take me to make back that $1,500 of spend that I'm using today to buy that rate down? And that might be 4 years, it might be 5 years, it might be 7 years, depending on the situation. You need to look at what's my ROI on the investment to buy the interest rate down. And it just completely depends on the interest rate market that we're in. What I would say is right now, this is a rate market where I don't always advise people buy the interest rate down because there is a chance in this particular climate that interest rates in general may fall in the near future. And if you spend thousands of dollars now to buy your rate down and it's going to be an ROI in 3 years or 4 years, but let's just say after you buy, rates come down after 6 months or they come down after a year and now you're in a position to actually refinance. Well, what will happen is that you'll just have left money on the table. You'll be out that money. You won't have gotten your return on investment. Those are the things that we help people navigate when it comes to interest rate, either buying it down or taking a higher interest rate and getting a credit and what that looks like. Now, here's the cool thing. You might be able to negotiate depending on the market, depending on the home, depending on the situation, you might be able to negotiate what are called seller concessions. Another word is called a seller credit. This is something that's done upfront or at different stages in the process where there's room or opportunity for further negotiation, which would be at inspection or at appraisal. But upfront, you're initially negotiating the opportunity to get seller concessions or seller credit. So for example, let's just say you can't afford to cover your $10,000 of closing costs. Like you need that to get covered somehow. The best way to do that is to ask the seller to provide a seller concession of $10,000, which will cover your total closing costs so you don't have to fork that out. And that's something that you'll work with your realtor and you'll work with your lender on making sure that that can take place. And maybe sometimes you can get the full amount covered or a portion of it. And it also depends on what you're willing to do when it comes to the house that you love. Another thing that a lot of people aren't aware of is you don't have to be the only one to potentially buy your interest rate down. You can use the seller's money to benefit yourself. You can get enough seller concessions to not only cover the $10,000 of closing costs, but maybe there's additional amount that can be used to also buy your interest rate down. And those are the things that we work with you on how to allocate those funds. This is not always possible in every market, especially if it's a seller's market, but in a buyer's market where listings aren't selling as quickly or there's time on markets higher, the opportunity to negotiate like this and take advantage of it can be an amazing thing and you can benefit from.